Every time you buy a share of a company, you're becoming a part owner. Cool, right? But what if that company paid you every few months just for owning it? No selling, no trading, just cash in your account again and again. That's a dividend. And dividend investing is one of the most popular ways people build passive income. Let's break it down, simply, clearly, and in plain English. A dividend is a slice of a company's profits paid out to shareholders. Think of it like this. A bakery sells muffins, makes a profit, and decides to share some of it with the people who helped fund it, the investors. You didn't have to show up, work overtime, or do a single thing. But because you own a piece of the business, you get a piece of the pie. Let's say you own 100 shares of a company that pays $1 per share per year. That's $100 in dividends. Simple. And most companies pay out quarterly, so you might get $25 every 3 months. Some investors choose to spend those dividends. Others, they reinvest them to buy more shares, which earns more dividends next time. That snowball builds bigger and faster over time. That's the power of compounding. So why would a company give away its profits? Well, not all do. Startups and fast-growing companies usually reinvest everything. But bigger, more stable businesses like Coca-Cola, Johnson & Johnson, or Microsoft, they've got plenty of cash and don't need to grow like crazy. So they reward shareholders with regular payments. That keeps investors happy and loyal. There are a few key terms to understand. Dividend yield. That's your return in dividends based on the share price. If a stock is $100 and pays $5 a year, the yield is 5%. Payout ratio. This shows how much of the company's profit is being paid out. A high payout ratio might look generous, but it could be risky if profits fall. And dividend growth. That's when a company raises its dividend year after year. Some companies haven't just paid dividends, they've increased them for decades. But here's the thing, dividend investing isn't magic. Dividends can be cut. A super high yield might be a red flag, not a bargain. And if you put all your money into just a few stocks, that's a lot of eggs in one basket. Smart investors look for consistency, strong financials, and a sustainable payout. So how do you start? Many beginners choose dividend ETFs, baskets of dividend-paying stocks. ETF stands for Exchange Traded Fund. It's like a shopping basket filled with dozens or even hundreds of companies, all bundled into one investment. Instead of picking just one stock, you get a mix, which spreads the risk and still gives you income. Two popular options, VYM, Vanguard High Dividend Yield, and SCHD, Schwab US Dividend Equity. Low fees, solid history, easy to research. Dividend investing can give you a steady stream of income. It rewards patience. And when you reinvest those payouts, it can turn into serious long-term growth. Your money doesn't just sit there, it pays you. Next up, a step-by-step guide to get started and build your first income portfolio. Hit subscribe. Stickonomics. Finance drawn simply.